Greetings. This video is going to be about basic education on how to check on the central economic indicators of the United States and interpret what you see in the news for yourself. So you can look this up without all the spin that you see in the news, and you also know when certain indicators may come out. Now I'm going to go really fast in this video because we're going to cover several of the most common indicators, so feel free to pause the video and see a certain section again. The first thing we're going to look at is the inflation rate, or consumer price index, for the United States. And yes, I have other videos that explain why the Goldman Sachs commodity index is the better worldwide inflation rate, but this video is about US statistics and the US statistics that you will see in the news all the time. So you go to the bos.gov website, ignore the distraction in the middle, and go to the right hand column, see the consumer price index over here, and click on this leftward of the two icons, the one with the little graph. And then go to more formatting options, and instead of just 1 month, we're also going to choose 12 month. Retrieve data. So you have 1 month change, which is a high frequency indicator, doesn't really tell you much about trends. But when you string those together into 12 month changes, you get this over here. Now all the media hype that you see right now about really high inflation, that is because of this little spike over here, which is already moderating and falling down. And I guarantee that by February or March, all the people who are predicting imminent hyperinflation, or even worse, saying that hyperinflation is already here, will be nowhere to be found, or they will double down on saying we have had hyperinflation for the last several years. That is, of course, not true. But this is where you can look at annualized inflation rates. Now you can see all my other videos on this topic about how money printing does not cause aberrantly high inflation. Just a sample of those videos include this one over here, as well as this one over here. Now we go to the next economic indicator, which is the job creation and unemployment rate. So you go back to the main web page, Payroll Employment, and more formatting options, original data value, and 12-month percentage change. These are the two that are important, but you could choose whatever you want. Once you become more familiar, you'll be able to know which option to select that results in what. Retrieve data. And then choose a time frame 1995, so the beginning of the dot-com era. And you can see over here the job boom of the late 1990s, the dot-com recession, which was concentrated mostly in one sector. So it didn't have that much of a decline in the total jobs number. The small recovery from that, then the real estate bust, which was a much bigger recession affecting all sectors. And since then, another big job boom, facilitated by the age of quantitative easing and why quantitative easing and money printing in general is necessary. Then the COVID-19 crisis, which is a very sharp fall, as we know, and the recovery from that. It has not yet reached its peak high from the pre-crisis period, but it's getting close to that. It is having some difficulty getting back up to that because certain types of service jobs have been obliterated. Anything that's customer facing, like a waitress or a barista or a barber perhaps, these are all in some trouble. But outside of this, there are more job openings in the United States than there have ever been before, as we will see later in this video. So this is the total job rate, and this is the annual percentage creation rate that we selected. The baseline is about 2% a year job growth, and recessions, of course, turn that into a negative. A sharp recovery of a greater percentage from the bottom occurs, then it flatlines into about 2% a year during the business cycle expansion. Now the COVID-19 crisis distorted all of this. You had a super sharp fall and an equally sharp rise. It's moderating back to this 2% level, but all of 2020 and 2021 are going to be very distorted data sets for that reason. And you can look at this and you can choose a shorter time frame if you want to see this in more detail. So instead of 1995 that I chose, just choose 2010. So you see the job boom, COVID-19 bust, recovery, and then weakening of the recovery as I described. Similarly here, baseline job growth, huge reduction, huge spike back upwards, and then return to the baseline trend line of job growth. So that's what we're seeing over here. So next we go to another website to look at another very important metric, which is nominal GDP growth. Now, as to why nominal GDP is the more important and precise metric instead of quote-unquote real GDP, read and listen to chapter 2 of my Atom publication over here. But in summary, Nominal GDP is the GDP growth without deducting out some assumption for inflation, and therefore is more closely tied to the revenue and expenses of a company and the wages that a corporation pays out to people. There's no corporation in the world, or even small business in the world, that releases its financial statements in both nominal terms and real terms. Furthermore, as I explained in my Atom publication, if inflation becomes too low, then the post-inflation GDP, the so-called real GDP number, also becomes lower because productivity goes down. Inflation is a necessary fuel for technological progress, as that publication describes. But the problem is that since all of these economists have formed their theories in the 1970s, they wanted to deduct out inflation from GDP, which can make sense over a 10-year horizon, but to do that on a quarterly basis is just futile. And that shows how super theoretical these economists really are, because they just don't think about what actually affects real businesses and real people. They believe making quarterly level deductions and then revising it 4 times. Remember, their real GDP number gets revised about 4 times after it's initially released, making any headline level initial release virtually meaningless. What you really want to look at to understand what's actually happening in the economy is nominal GDP, and it's very hard to find. You can't even find it from a Google search. You have to go to great lengths to even find it, because the economics establishment doesn't even understand why that is important, with 1 or 2 notable exceptions. So you go to data by topic, gross domestic product over here, then you scroll down all the way to supplemental and additional data. This looks like a very unimportant section and footnote because it's at the bottom of the page. And then once you expand that particular topic, you get to this percentage change from preceding period, which is an Excel spreadsheet that gets downloaded. That's how much trouble you have to go to just to find out what the nominal GDP number was for a prior quarter. You can't just find it from a Google search. It's really quite absurd. So as I expand that sheet, now you have quarterly numbers and annual numbers over here. Among these 2 subsections, you have 2 columns each, and the leftward column is the nominal number, current dollars, and the rightward column is the real number. So what you want is the leftward number over here, which is the nominal number, and you want the annual number because the quarterly number is too noisy, but we'll look at that as well. And this represents the nominal GDP for individual calendar years. This is the real GDP after they take out that CPI inflation. This is the nominal GDP, and therefore an indication about whether the economy is getting enough fuel under which technological progress and the productivity of technological gains can occur. And you can see that it has been languishing in the 3s and 4s for a very long time. Any nominal GDP less than 5% a year indicates that there is not enough velocity of economic activity and also not enough fuel that technology can consume to generate more and more productivity. Now, if you look at the quarterly numbers, these are, of course, very distorted by COVID. Over here, you can see nominal GDP, a severe negative plunge, and then some positive increases, which are to be expected. That's why we go for the annual number. But you should look at this every quarter to get an idea of what nominal GDP growth rates are. Obviously, these double-digit nominal GDP growth rates at a quarterly level will moderate back down. The question is, will we have a policy framework that, if you go back to the annual numbers, will allow us to finally get back above 5% a year? In the 80s, 90s, things usually were well above 5% a year in nominal GDP, and inflation was not really high then. Inflation is lower now than it was then, but it wasn't high then at all. But the lower inflation has also created lower nominal GDP and also lower real GDP, because real GDP cannot be decoupled from inflation, no matter what the theoretical economists actually think by deducting that out. If inflation becomes too low, real GDP also becomes too low, even if they think they have separated inflation out from real GDP. And I discuss all that in Chapter 2 of my Atom publication, as well as Chapter 4 of my Atom publication, which you can read and listen to in this link over here. So that is nominal GDP. Now we will look at another website for the final 3 metrics that we look at in this video.